Hello and welcome. In this video, we look at the bull put spread trade. This trade is placed when a trader is bullish on price, but wants to limit his possible loss to a fixed maximum amount. The bull put spread is one of the four most basic spread trades. The concept of the four basic spread trades is using two offsetting options, such that the potential profit and potential loss both have fixed maximum amounts based on the difference between the premium for both options that is either collected or paid up front, and the difference between the two strike prices. It is important to remember that because a trader can either buy or sell a put option, and a trader can either buy or sell a call option, the pricing of options is necessarily based on probability of outcome. Therefore, the ratio of the maximum possible profit versus the maximum possible loss is directly proportional to the probability of the trade making money. To place a bull put spread, a trader sells a put option and buys a put option with a lower strike on the same stock that both expire at the same time. The option the trader sells has a higher strike price and therefore a higher cost, and the option the trader buys has a lower strike price and a lower cost. Because the trader is selling a put option with a higher strike price than the put option that he buys, the cost or premium the trader collects up front for the option he sold will always be higher than the cost he pays for the option he buys. In other words, the trader collects and keeps the difference between the two premiums. The trader's maximum potential profit for this trade is the difference between the upfront premium he collects selling the put with the higher strike price and the upfront premium or cost the trader pays to buy the put with the lower strike price. The trader's maximum potential loss is the difference in premiums that he collects up front, minus the difference between the two strike prices. Let's look at an example using GLD, the gold ETF. At the time of making this video, GLD is currently $126.96 a share. A trader could place a bull put spread by selling the $126 put option and buying the $125 put option. Both of these options expire in about 5 weeks. The $126 put option costs $1.77, and the $125 put option costs $1.37. Selling the $126 put and buying the $125 put means the trader collects 40 cents a share up front. The 40 cents up front premium that the trader receives is his maximum potential profit. If the price of GLD remains above both strike prices, both options expire worthless, and the trader keeps the 40 cents that he was paid up front placing the spread. If the price of GLD drops below $126, the put option that the trader sold begins to have intrinsic value. If the price of GLD drops below $125, the put option that the trader bought begins to have intrinsic value. This means that for $125 and below, the loss on the option that was sold is the same amount as the gain on the option that was bought. So let's break this down. The trader sold a put option with a strike price of $126. Therefore, the trader is obligated to buy GLD for $126 from the person that purchased the $126 put option if the price of GLD is $126 or below when the options expire. The trader also bought the right to resell GLD for $125 if the price of GLD is $125 or below. Therefore, if the price of GLD is $125 or below, the trader buys GLD for $126, sells it for $125, and loses $1 per share. However, he was paid 40 cents a share up front placing the spread, so his loss is the 40 cents he was paid up front minus the $1 he loses on GLD, for a loss of 60 cents a share. This is his maximum possible loss on this trade. It's important to note that if this was a real trade, the trader doesn't actually buy and resell GLD. If he holds the spread until the options expire, the profit or loss is simply added to or subtracted from his account. If the price of GLD is between $126 and $125, the option the trader bought expires worthless. However, the option the trader sold has intrinsic value. The strike price is $126, and the price of GLD is below $126. The intrinsic value is the difference between the strike price and the current price of GLD at expiration. In other words, the trader must theoretically buy GLD for $126 and sell it at the market price that is between $125 and $126, losing the difference. That loss is subtracted from the 40 cents the trader was paid up front. The break-even point is the difference between the strike price of $126 and the 40-cent premium the trader was paid up front for placing the spread, making the break-even point on this trade $125.60. If the price of GLD is between $126 and $125.60, the profit is between 0 and 40 cents a share. If the price of GLD is between $125.60 and $125, the loss is between 0 and 60 cents a share. So to recap, GLD is currently $126.96 a share. If the price of GLD is above $126, both options expire worthless and the trader keeps the 40 cents a share that he was paid up front as profit. This is his maximum possible profit. If the price of GLD is below $125, both options are exercised, meaning that the trader buys GLD for $126, sells it for $125, and loses $1 on GLD. However, he was paid 40 cents a share up front, so his loss is 60 cents a share. This is his maximum possible loss. If the price of GLD is between $125 and $126, the put option the trader bought expires worthless. However, the put option the trader sold has between a $0 and $1 worth of intrinsic value per share. The trader loses this value. However, he was paid 40 cents a share up front, so his profit or loss is the premium that he collected up front, minus the intrinsic value of the option that he sold. The break-even point on this trade is $125.60 a share. So that's the bull-put spread. In the next video, we will continue with the bull-put spread by looking at more examples. I hope that you enjoyed this video. Thanks for watching.